My name is Ruben Bock. I'm the Portfolio Manager for Atticus, which is the investment management arm for AFPG. We are providing you with these video updates to keep you better informed with markets and show what it means for investors. In the last video update, we took a look at market expectations for earnings growth in Australia and concluded that they were perhaps a little high. Fast forward to today, and we have seen a material correction in those expectations, with markets falling by around 15% since their highs in September 2018. This fall is shown on the right-hand side of this chart, which shows the performance of Australian shares over the past decade or so. This has meant that the average balanced investor has seen a 6% decline in their portfolio value recently. Some balanced investors have done worse, with one of the largest industry super funds declining 10% during this period. Our balanced portfolio has performed reasonably in line with the averages. Today, we are looking at whether this equity market sell-off could be a buying opportunity or whether investors should be preparing for more pain ahead. Because for investors, the recipe for high returns is a combination of positive and improving earnings growth and valuation levels which are as low as possible. Let's take a look at these elements in this chart of the global equity market over the last 20 years. The heavy blue line is the price level. You can see the 15% price pullback towards the very end of 2018 on the right-hand side. The light blue line shows earnings, which is a key measure for the direction of future share prices. After a strong growth period during 2017, earnings growth has tapered off more recently, but the uptrend still remains in place. If we were at the start of a recession, we would be seeing a negative trend in the earnings line. Currently, we are not. The black line at the bottom of the chart shows the valuation level. The combination of a fall in prices with a stable level of earnings has meant that valuations are at the cheapest levels we have seen since 2013. This second diagram gives us another perspective on valuation levels. This chart is basically showing us whether investors are getting a higher yield by putting money in the bank and earning interest, or by putting their money into shares and receiving company profits. Let's look at the Australian equity market, for example, which is on the far left side of this diagram. The key to this chart is the position of the orange dot relative to the black line. If the orange dot is positioned alongside the black line, it would be saying that shares are fairly priced. Currently, the orange dot is well above this black line, and this is saying that, relative to cash in the bank, the return from shares is very attractive. In fact, as you work your way across, those orange dots are above the corresponding black lines, which is saying that equity markets are cheap on a historical basis. Putting this all together, we think the ingredients are all in place for higher returns for investors from these reduced price levels. And how are we implementing this intel into our own portfolios? Well, we have recently bought around 5% equity exposure in our portfolios with a preference for offshore equities over domestic. We need to be vigilant to monitor the trends in earnings growth as well as valuation levels to ensure this exposure is managed profitably. And that's something we will talk about more in a future video update.